Right now, 43% of Americans could not cover a $1,000 emergency without going into debt. Not people who are broke, regular people with regular jobs, regular paychecks. And here's the uncomfortable part. Most of them will never fix this by earning more money because money has a strange habit. It keeps rewarding the exact same decisions, decade after decade, no matter what the economy is doing. Look at people who quietly built real wealth over the last 50 years through recessions, inflation spikes, market crashes, and bubbles bursting. And you'll notice almost all of them made the same handful of moves, not trends, not hacks, decisions that simply never stopped working, no matter who was in office, no matter what interest rates were doing, no matter how scary the headlines got that year. What actually separates people who build wealth from people who stay stuck isn't income. It's a specific set of decisions repeated over and over. We found 10 of them. Let's start at number 10. Number 10, build a cash buffer before you need one. That 43% statistic isn't random. It's the direct result of skipping this exact step. For many families, a single unexpected bill is enough to trigger credit card debt, missed payments, or a loan with painful interest. Now, cash has developed a bit of a bad reputation. Every time interest rates fall, someone declares that cash is trash during a bull market. Cash feels lazy because it isn't climbing as fast as stocks or real estate. Watching money sit in a savings account can feel like missing out, but that misses the real purpose of cash. Cash isn't supposed to make you rich. Cash is supposed to keep you from becoming poor. The people who need money the most are usually forced to sell assets at the worst possible moment. People with cash don't have that problem. Instead of selling investments during a downturn, they can leave them alone to compound. Instead of putting an emergency on a credit card, charging 25% interest, they pay the bill and move on. Sometimes they even become buyers while everyone else is selling. History is full of examples. During the financial crisis of 2008 and the market panic in early 2020, investors who had cash on hand were able to buy quality businesses at prices that looked impossible just months earlier. Those purchases often became some of the best investments of the decade. Even giant companies keep cash reserves all the time. Warren Buffett's Berkshire Hathaway regularly keeps tens of billions of dollars sitting in cash, even when critics complain the money isn't fully invested. The same principle works at a personal level, too. An emergency fund isn't just a pile of money, it's a decision-making tool. It gives you time to think instead of forcing you to panic. Money creates freedom long before it creates luxury, and once you've protected yourself from life's unexpected expenses, the next question becomes obvious. How do you make sure there's more money arriving every year than the year before? Number 9, increase your income every year. If your income stays flat for more than 2 or 3 years, your lifestyle slowly moves backward, even if your paycheck looks exactly the same on paper. For a long time, the standard advice here was simple: switch jobs, because job hopping almost always paid more than staying loyal to one employer. That used to be reliably true. Here's the twist, though. The newest wage data from early 2026 tells a different story. The gap between what job switchers earn and what people who stay put earn has nearly disappeared. Switchers are seeing raises of around 4%, while people staying in their current roles are getting about 3.5%. Compare that to just a few years ago when switchers could pull in raises of 7 or 8%, more than double what loyal employees received. That old shortcut is quietly losing its power. Which means the real lesson here isn't job hopping, it's making income an active project instead of a passive expectation. Learning a specialized, in-demand skill increases your earning power, regardless of whether you switch jobs or not. Negotiating your salary permanently raises every paycheck that follows. Building a small side income creates a second stream of money that isn't tied to any single employer at all. The specific method matters less than the habit. Every single year, you should be able to answer one simple question: how is this year's income going to be larger than last year's? Because your career is often your biggest financial asset long before your investment account ever becomes one. And once more money starts coming in, a new temptation shows up almost immediately, waiting for the perfect moment to invest it. Number 8, increase your savings rate before you chase a better investment return. Everyone agrees that saving alone won't magically make you rich, and that's true. But somewhere along the way, people started treating savings like it barely matters, while investing became the answer to every financial question. The truth that most people don't want to say out loud is that for the vast majority of us, that's actually backwards. Say your goal is to improve your finances by $10,000 this year. There are two ways to get there. The first is investing. Assuming a healthy annual return of around 7%, you'd need roughly $143,000 already invested just to generate that extra $10,000 before taxes. Most people simply don't have a portfolio anywhere near that size yet. The second option is keeping more of the money you already make. That might mean skipping one expensive vacation, driving your current car for 2 more years, negotiating a better insurance rate, cooking at home more often, canceling subscriptions you barely use, or resisting a purchase that feels exciting today but will be completely forgettable in 6 months. Now, before you dismiss this as some kind of scarcity mindset, consider that wealthy people spend an enormous amount of time trying to keep more of the money they already have. Holding companies, trusts, tax attorneys, family offices, estate planning, none of these are money making machines. They're money keeping machines. So here's a question worth sitting with for a second. Look at your last bank statement and find one recurring expense you would barely even notice if it disappeared tomorrow. That one answer might be worth more to your future than any stock tip you'll hear this year. Number 7, buy assets that pay you to own them. Not all assets work the same way. Some assets simply become more valuable over time. Others become more valuable over time while also paying you to hold on to them. That small difference has created an enormous amount of wealth throughout history. Think about a gold bar. If the price of gold rises, you've made money. The same is true for a rare watch, a collectible car, a piece of art, or even your own home. These assets can appreciate. And one day, someone might be willing to pay you more than you originally spent. Now, compare that to a productive asset. A rental property sends you rent every single month. A dividend paying company distributes part of its earnings straight to shareholders. A self storage facility collects rent from tenants around the clock. According to Federal Reserve data, the wealthiest households hold a dramatically larger share of their wealth in businesses and corporate equity than the average household does. In fact, the richest 1% own more than half of all public and private business equity in the entire United States. These assets produce cash while they're becoming more valuable, and that cash can be reinvested into acquiring the next asset. The asset starts helping you buy the next asset. That's how wealth begins to compound beyond investment returns alone. Think about the difference this makes over 20 or 30 years. Someone holding a non productive asset is waiting on a single event, a future sale, to ever see a return. Someone holding a productive asset is getting paid along the entire journey and using those payments to buy even more productive assets. One person is hoping the market eventually agrees with them. The other person is getting rewarded every single month, whether the market agrees or not. That's not a small distinction. It's the entire reason some portfolios grow exponentially while others just sit there waiting for a lucky exit. Number 6, own equity whenever possible. There are only a handful of moments where ordinary people suddenly become wealthy. An IPO, an acquisition, a partner buyout, stock options vesting, the sale of a family business, or an inheritance. They all share one thing in common: their equity events. When Microsoft, Apple, Nvidia, Amazon, and Google grew from ambitious companies into trillion-dollar giants, salaries certainly increased along the way, but thousands of employees became millionaires because part of their compensation was tied to ownership instead of wages alone. And this isn't just history, it's happening again right now with the current AI boom. Reports suggest that roughly 78% of Nvidia employees are now millionaires, largely thanks to stock they were granted years ago. OpenAI reportedly paid its employees an average of $1.5 million in stock based compensation in a single recent year. To be fair, equity isn't guaranteed money. Most stock options granted at small, unproven startups end up worth nothing because most startups fail. But when equity does work out, the payout can equal decades of raises and promotions combined. People negotiate salaries, while the wealthy negotiate ownership. If you're joining a startup, ask about stock options. If you're helping grow a small business, ask whether there's a real path to partnership. If you're freelancing for a client whose business is exploding, consider whether part of your compensation could be tied to that future success. Number 5, negotiate every major purchase. Most people negotiate their salary, very few people negotiate what they spend. That's strange because financially, the outcome is exactly the same. If you negotiate a $10,000 raise, you've made more money. If you negotiate $10,000 off the price of a house, you've also made $10,000. The only real difference is that one of them usually arrives before taxes. Somehow, we've all accepted the idea that prices are fixed. Walk into a grocery store, and sure they are. Walk into a car dealership, a furniture store, a contractor's office, or a real estate transaction, and very often they're not. That's exactly where thousands of dollars quietly change hands every single day. The next time you're about to make a purchase, you'll still remember 5 years from now. Pause before saying yes. Ask for a better price. Ask for better financing. Ask for better service. Ask whether there's any flexibility at all. The worst answer you'll ever get is no. The best answer might save you more money than your next raise. Number 4, leave low sailing careers early. Every industry has a ceiling, and it's worth checking what that ceiling actually is before you spend years climbing toward it. There are 2 simple questions that can help you find it. First, is this industry creating more opportunity than it did 5 years ago? Second, are the people 10 years ahead of you actually living the life you want? If the honest answer to both is no, it's time to leave. Every profession essentially has 3 ceilings: an income ceiling, meaning how much the top 10% in that field actually earn. If the absolute best people in an industry top out at $90,000, that's your income ceiling. A demand ceiling, meaning whether demand for that skill is increasing, staying flat, or shrinking. And an ownership ceiling, meaning whether you can eventually own something like an agency, a business, equity, or a partnership, or whether you're permanently just selling hours of your time. Before spending 10 years becoming exceptional at something, spend 10 hours making sure it's actually worth becoming exceptional at. This isn't about abandoning a career the moment it gets hard. Every field has difficult stretches. It's about noticing the difference between a temporary rough patch and a structural ceiling that isn't going to move no matter how good you get. A rough patch is worth pushing through. A structural ceiling just wastes another decade of your life before you finally admit what the data was already telling you. Number 3, avoid lifestyle inflation. You know what's more exciting than a brand new car? A brand new car. Every lifestyle upgrade comes with an expiration date, and every improvement in your life fades out much faster than you'd expect. There's a real psychological term for this. It's called hedonic adaptation. In plain terms, it means people tend to return to a fairly stable baseline of happiness after both positive and negative life events. In real life, that means you could move into the most expensive penthouse in the city and drive the newest sports car available today. And the excitement will only last for about 6 months before it starts to fade, and you'll find yourself quietly looking for the next upgrade. So be aware, special becomes standard very quickly, and no purchase is immune to that. Number 2, don't finance depreciation. The faster something loses value, the less willing you should be to borrow money to buy it. This doesn't mean you should never finance a depreciating asset. Sometimes you genuinely need a car, and that's fine. The point is to understand the trade-off you're actually making. If you're borrowing money for something that will be worth less every single year, make sure the value you're getting from it is greater than the money you're losing. A work truck that helps you earn a living is very different from a luxury SUV that mostly exists to impress the neighbors. Paying extra for the privilege of owning something that's constantly becoming cheaper is a hard game to win. And number one, know which bucket you're spending from. Before every major purchase, ask yourself one question. Am I paying for this with income, returns, or principal? Income is the money you earn from working. Returns are the money your assets generate on their own. Principal is the asset itself. Say you want to buy a boat. Maybe this year's bonus pays for it. Maybe the rent from a property you own pays for it. Or maybe you have to sell part of your investment portfolio to afford it. It's the same boat, but three completely different financial decisions. That's exactly why so many wealthy families, university endowments, and charitable foundations follow one simple rule: spend the returns, protect the principal, because the portfolio only has one job: keep producing. That doesn't mean you should never sell an asset. Sometimes selling part of your portfolio to travel the world, help your kids, or buy your dream home is exactly the right decision. Just be honest with yourself about what you're actually doing. Financially, you're making your portfolio smaller. Maybe you're making your life bigger. Neither one of those is automatically right or wrong. You just need to know which trade you're actually making. Most people never ask this question at all. They just spend and only find out months later which bucket the money actually came from, usually when a bill or a tax form forces them to look. The families and institutions that protect wealth for generations aren't smarter than everyone else. They just ask this one question before every major decision instead of after. So there they are, 10 decisions that have quietly outlasted every recession, every crash, and every bubble of the last 50 years. Notice something about all 10 of them. Not one requires a lucky break, a perfect market, or a genius investment. No hot stock tip, no perfectly timed trade, no wealthy relative. They're just decisions made consistently, over and over again, by people who mostly started out completely ordinary. If you had to be honest with yourself right now, which one of these 10 are you actually doing well? And which one have you been quietly avoiding? Drop it in the comments. I'm genuinely curious which number hit hardest, and I'll be reading through them. If this list gave you something you can actually use today, hit subscribe, because we're breaking down decisions exactly like these every single week, and the next one might be the piece you're missing. And if there's someone in your life who needs to hear this, someone stuck thinking their situation is permanent, send this their way. It might be the 10 minutes that changes how they think about money for good.